help draw it all together. Michael Gurka, founding principal at BruinHill Partners. He joins us from the CME Group out in Chicago. In studio with us here in New York, Hank Smith. He oversees more than $6 billion, mostly in dividend-paying assets, as Chief Investment Officer of Haverford Trust. Great to have both of you with us. Michael, though, I want to kick it off with you. Tell me what's going on here in this last 30, 40 minutes of trading. A big sell-off, and then we bounce back. What's going on?
I think right now one thing that has to be looked at is on a 2-year weekly chart in the S&P. Last week we set a big Fibonacci retracement level, which became resistance at 1228, and we held it. It's the second time we've held that this year, and all I can mention to that is the next level I see for support in the market is 1121.
So you're
the
saying
divergence between the S&P and the DAX is big right now.
So all technical in your view?
I think it is right now, at least. I mean, you can look at two things right now, which is the Fed and the dollar, and then you look at the way the equity markets are trading. I think the equity markets have diverged themselves from the Fed, so that's why it's technical in nature.
I wonder if you think the equity market, Hank, I'll ask this of you because you list a number of positive data points that we've seen, which is why you think the market has done so well since August, plus QE2. But does the equity market, has it divorced itself from the reality in the European sovereign debt crisis? Because we have a worsening situation in Ireland, and it doesn't seem that equity markets here or in Europe really care that much.
No, they've gotten used to it. This problem's been around since last spring. It comes, it goes. Now it's back. But the market's come a long way from the September lows, but it hasn't gotten ahead of the fundamentals. We've just almost completed third quarter earnings reporting season. Earnings up 36%, top line growth, bottom line growth, and valuations remain very compelling in here.
Hank, let me ask you, because you were expecting or said we could see a bit of a pullback after we got through the Fed, after we got through the elections. Is that what we're seeing? Is this the pullback you kind of anticipated?
I think so. A little bit delayed. I think what got in between the FOMC meeting and the elections was great manufacturing data and great employment data, which really propelled the market on top of the news of the elections and the FOMC. Now we're getting a little bit of that pause, but we think it's going to be viewed as a buying opportunity as we head in toward year end.
Well, do you think we're going to go down even further? I mean, how much of a correction or pullback would you like to see here or expect?
I don't think we're going to get a correction as defined by 10%, as defined by 10% or more, but a pullback of 3 or 4% should not alarm any investor.
And it would be a buying opportunity.
Absolutely.
Hey, Hank, it's Adam. Let me jump in if I may. I'm just curious, why a buying opportunity? Why is it going to be perceived as a buying opportunity as opposed to an opportunity to put some profits in your pocket? Why the perception?
Because there's still a ton of cash on the sidelines. There is still a lot of skepticism. We've had so much money come out of equity funds into bond funds, and that has continued even this fall. And so there is still fear and distrust of this market. That is a positive.
Normalcy, or just that they've got a lot of cash on hand, like a lot of companies do. So we're seeing them do buybacks and dividends. I mean, which is it?
Well, it's either one. It's an expression of confidence in fundamentals and in the future. So it's a very positive, and investors still have the opportunity today to get big, juicy yields that also give you the opportunity of growth of income. And compared to fixed income, in our view, it's a no-brainer.
Although you heard Zara down the New York Stock Exchange talking about the fact that Treasury yields are backing up, that would make dividend-paying stocks less attractive. What if the bond vigilantes come back? I mean, is that even a concern? Is that even on your sort of radar screen, or is it just not going to happen right now?
Well, it's not on the near-term radar screen. Certainly longer term, if we build inflationary expectations, which we don't have now. We do have some commodity inflation, but we don't have inflationary expectations. That would be a problem. And the bond market could make it a problem very quickly.
You don't have any inflationary concerns? I mean, with all of the money that the Fed is printing and pumping out into the system, obviously now we don't see it, but 6 months, 1 year, 2 years down the road?
For inflation to be insidious, you need a wage price spiral. And it's hard to make the argument that we're going to have a wage price spiral anytime in the near future. Commodities, remember, are cyclical. They can go down as quickly as they're coming up.
Well, let's ask Michael, because you trade commodities. Michael, what's going to happen with commodities? They've had a nice run here.
Oh, I'd agree with that. They are cyclical, but for the same reason, I think you're going to see, at least as in copper, another retracement back up to the all-time highs, up above 427, which is a little bit more than 5% from where we're trading right now. And I really would put that on the fundamental aspect of global demand, not just from the BRIC countries, but the emerging markets. There is so much international growth going on right now. The commodity space is the biggest benefactor of that, and these are not normal times, which is why pragmatic thinking and fundamentals aren't always the case.
Well, as Neil Grossman says, it's actually the new abnormal, which I kind of like here. But I mean, Michael, you're saying
the new malaise. I like
the new malaise. There's a lot of good ones. I mean, you find that most of the commodities are trading on fundamentals, or is it all of this loose cash flying around? Thank you, to the Fed.
Increased liquidity here.
Well, there's a lot more choices with that cash than there has been, and for that same reason, then this definitely thirst for yield right now, at least, that's where the Treasury market is going to continuously lose. And again, that's why I would not use the barometer of gold right now, or even silver on these spikes, but copper.
5 seconds, Hank. Got a good investment play or a favorite play right now? Got to be quick.
Keep it balanced between cyclical exposure with industrials and basic materials, but also the steady eddies from consumer staples and healthcare.